Hello all, this is Vishwesh from research team at Money Works for You. We are a mutual fund distributor based out of Pune. In this video, we'll talk about IT sector. Before we start, I'd like to tell you that this video would be only for educational purpose and we are not giving any financial advice in this video. We'll straight away jump into IT sector fundamentals. Within fundamentals, I'll talk about revenue growth. So there was a data from latest RBI bulletin. I'll zoom in into this. So the gray line that you can see is for IT. This is the sales growth data, the chart. So there has been gradual increase in sales growth. So there was a bottom in Q3 FY24. There was bottom of 3% sales growth that time. Since then, there has been increase and currently there is about 9.5% sales growth for Indian IT. So there is gradual increase for a few of the quarters, couple of quarters. There have been also an increase, sharp increase. So it's quite a positive sign. The other positive sign in terms of growth is there was upgrade in the revenue growth guidance given by Infosys. They guided about 4.5 to 5% constant currency terms for FY26 for this FY26 year. With that, the guidance previously was lower to 4.5%. So there has been increase in 0.5%, 50 basis point for the FY26. So generally, Infosys is quite conservative in terms of giving the guidance, but they have upgraded the guidance, so it is quite positive sign that we can consider for an industry as a whole. The other important thing is the next point is the BFSI sector is looking good. So majority of revenue for Indian IT comes from banks, international banks, US banks. So one of the heads of banks and financial services from Infosys, they are telling that banks, asset and wealth managers, custodians, card providers are leaning towards AI, they're adopting AI faster. And this is different from previous tech shifts like cloud and digitalization. So they are saying that for the past shift that we had seen, like cloud and digitalization, the banks were a bit slow with terms of adopting those shifts, those technologies. But the AI technology, they are adopting it fast. So they have been implementing AI into the business. If they are implementing AI into the business, it is quite beneficial for Indian IT to get those revenue from them to implement those AI for those banks. So it is quite bullish for Indian banks that BFSI, the international banks are implementing AI. The other important thing is Indian IT are adopting AI. They are partnering with AI giants like Infosys partnered with Anthropic recently. The partnership was focused on agentic AI systems. TCS also partnered with OpenAI. The partnership was about AI data centers, building AI data centers. So the main crux over here for this thing is the Indian IT is partnering with this disruptors to get the business, to get the new revenue that can be generated using AI. So that is the capture that Indian IT is doing by partnering with those disruptors. The margin has been steady during all this AI disruption. There has been a steady margin hold from this Indian IT. There is no any deterioration. There is no any decrease in Indian IT margins, profit margins. So if we talk about 9-year FY26 data, there has been 50 basis point increase despite AI headwind that they are seeing. So they have been able to maintain their margin. They are also guided to maintain their margins further. They are also invest into AI so faster. So we'll keep on investing and they will maintain the margin. That is the guidance that has been given. So it is quite positive that they have been able to maintain their margin. Going forward as well, they will be able to maintain their margin and also invest into AI. The other point is order book. So if we talk about 9-month FY26, there was 40% increase in total contract value, the new total contract value for Infosys. So it is quite positive. There is a 40% increase in new deal total value contract for Infosys. The other point was new booking. There was increasing 43% Y on Y for HCL Tech. The data was for latest quarter Q3 FY26. And the deal wins for Tech Mahindra are at 5-year high that they are seeing. The order book deal wins are quite strong. There is no any change that had happened because of AI. They have been getting the orders. They have been increasing the orders by a great significant margin. So it is quite positive sign. The other factor was about the earnings growth. So earnings growth is faster than stock prices. So if I talk about TCS and Infosys, I'll pull up Infosys over here in screener. So I'll go down and over here you can see profit growth and this is the stock performance. So if you look for 3 years, the profit growth is about 6%, but stock has fallen 5%. The profit growth for the last 5 years has been 10%, but the, the stock has delivered minus 1% growth. If I talk about TCS, the profit growth has been about 8% for last 5 years, but stock is down 4%, 8% same for 3 year, but stock is down minus 10% for the 3-year period. So the profit growth is outpacing the stock performance. The stock is declining, but the profit is increasing. So it is quite good time to invest into the Indian IT, looking at the profit growth. The other point is cash flows. So JP Morgan recently given a report on Indian IT sector. So they are saying, looking at the cash flows and dividend yield, Indian IT is at the cheapest levels seen in global financial crisis and at COVID times. So they are saying, looking at the cash flow that Indian ITs are generating, the valuation is currently trading similar to levels seen in COVID times and in 2008-2009 times. So they are showcasing the attractiveness, looking at the cash flows this Indian IT being able to generate. Same data was given by Motilal Oswal. So the cash flow yield 6.3, 6.4, we are near those big levels. It tells the attractiveness of the valuation that the current level is trading at. The other valuation matrix, PE valuation, the historical PE valuation, if we talk about, pull up PE valuation, I'll max out. This is the data from 2006. Since then, the median valuation, the PE valuation has been about 22.3x, but currently it is trading at 21.3. So the current valuation, PE valuation, is quite low compared to the median valuation. So it tells the valuation comfort, valuation attractiveness as well in terms of PE valuation. If we talk about technicals, Within technical, I'll talk about Nifty IT relative to Nifty, the relative performance of IT compared to market in general, represented over here by Nifty. So this is the chart. So over here you can see there was peak performance back in 2000s when IT was doing great, and there was drop in IT prices. There was a low made in 2008, and since then the IT have been slowly and gradually increasing compared to broader market. But now I have put in RSI over here. You can see the second largest oversold position right now, the Indian IT compared to Indian market. The, the RSI is at 35. It has been lower, second lowest since 2008. So this is the oversold position of Indian IT compared to Indian market. So relative attractiveness, we can see over here the sector wise attractiveness compared to Indian markets in general, broader market in general, looking at the technicals. So these are the things that we discussed, talked about. Talk about fundamentals, revenue growth, BFSI been investing into AI, Indian IT been partnering with AI giants, margins been steady and been hold, and future guidance of maintaining those margins have been there. Order book has been good, new orders been coming, increasing growth for that. The earnings growth is there, but the stock performance is not there. The earnings growth is outpacing the stock performance. The stocks are cheaper compared if we talk about the cash that they are generating. We also talked about the valuation, the PE valuation. We also talk about technical attractiveness and oversold position of Indian IT compared to marketing level. So these are the points we talked about. We are quite bullish on Indian IT. It is a contra bet right now, but we feel that there is a valuation comfort, there is earnings growth which is happening. It's a better time to invest. But at the end, this is not an advice. This is only for educational purposes. If you want to invest, you can invest with us. You can contact us at Money Works for You. We will be happy to serve you. Right? I'll end this video. Thank you.